So, Chapter 9, Business and Consumer Loans. So, what are loans? So, a loan is a money lent by a financial institution like a bank that must be repaid with interest. So, first is principal, the amount borrowed, interest, cost of borrowing, and maturity, length of time to repay. And second is type of business loan. So, natay A, B, and C. So, A is a short-term loan, usually less than 1 year, used for working capital, inventory, or payroll. Example, mga credit lines. And B is intermediate or term loans, 1 to 5 years, used for equipment or expansion. And next is C, long-term loans, so more than 5 years, used for major investments, buildings, large projects. And 3 is business loan in structures. So term loans, fixed repayment schedule, regular installment, and line of credit, borrowed up to a limit anytime, pay interest only on amount used. Next is revolving credit, reusable 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 credit or similar to credit cards. And next is secured versus unsecured loans. So no collateral by higher risk. Type of consumer loans is natay ABC, which is installment loans, credit cards, and mortgage loans. So ang installment loan is fixed payment over time. Example, a car loan or personal loans. And next is credit cards. So, ang credit card is revolving credit, high interest but flexible. And next is mortgage, loan used to buy real estate, long term, 15 to 13 years. So, 5 is key factors and loan decisions. So, lender evaluate borrowers using the 5 C's of credit, which is character, capacity, capital, collateral, and condition. So, ang character is the borrower reputation or credit history, while the capacity is ability to repay. And the capital is the borrower financial investments, and collateral is the asset pledge. And next is conditions or economic environment. So number 6 is loan pricing. So banks determine interest rates based on risk level, market interest rates, loan maturity, and borrower credit worthiness. And number 7 is risk in lending. So default risk is a borrower fail to pay, and interest rate risk is rate change. And next is liquidity risk or bank lacks cash. And number 8 is credit analysis process. So step banks follow. So number 1 is application review. Number 2 is credit investigation. And number 3 is financial analysis. And number 4 is approval or rejection. And number 5 is monitoring after approval. So number 9 is the importance of loans. So help business grow, support consumer spending, drive economic activity, and that's all.